Let us look at under what scenarios would the royalty and FTS be taxable in India. The first such situation could be that there could be an Indian resident, who pays royalty or FTS to a US resident or a PE of US resident in third country. Let's just look at this graphically. So there is an Indian company which is making payment of royalty and fee for technical services to a foreign company which is based out of US. The second situation could be that this foreign company has a PE in United Kingdoms, and the Indian company makes a payment of royalty to such a PE, right? In both these situations, there are chances that this royalty may be taxable in India. For our discussion, I'm using the word royalty quite often, but whenever I'm using it and RFTS is mentioned, it mentions for royalty as well as fee for technical services. The second situation could be that there is a non-resident, who has an Indian connection and he pays royalty or FTS to another non-resident. So we have a foreign company which makes a payment of royalty and FTS to another foreign company. These two companies are based out of US, right? But the company which is making the payment has a business in India, right? If this royalty is paid in connection with this Indian business, this could accrue or arise or deemed to accrue or arise in India. Now, when I say a non-resident, for that purposes, what the residential status of the foreign company, right, whether this company is a foreign or not, needs to be ascertained as per Article 4 of the relevant treaty, right? What Article 4 stands for? For that, we will have a different set of presentation which you can go through. Now, in such cases, when a payment of royalty or FTS is made, it is important to understand what are the inter se rights of India and the other contracting state, which is the treaty partner, wherever a payment of royalty or FTS is made. So for the purpose of this slide, we have an Indian assessee who is making payment to a US company, a foreign company, for royalty and FTS. Typically, this Indian company or India is known as the source state, whereas the foreign company is known as the resident state. Right? In case of royalty and FTS, generally what happens is that India levies a withholding tax on the gross amount. So let's say if the total payment which is being made is $100 and India applies a withholding tax of 10% on this payment, India is going to keep $10 as withholding tax from the income which is payable to non-resident, right? These withholding tax rate, like I said, is applied as per the treaty or act, whichever is more beneficial, on a gross basis. This 10 is applied on the gross amount of 100. It is not that from 100 you reduce the expenses and let's say if X is the balance that you get, you apply 10% on that. No, this is now not how it works in case of royalty or FTS. For royalty and FTS article, the rate of tax of 10 is applied on the gross number. So once this $10 of withholding tax is applied, now if I have to see in terms of the number, suppose $100 were there, $10 were deducted by India, $90 is what the foreign company receives. But like I told you, in addition to India, even US has a right to tax this royalty or FTS. The difference between the first case and the second case is that the gross amount of $100 may be taxed as business income on a net basis after deduction of expenses. So unlike India, where we had applied this rate of 10% on 100, in US, what they will do is they will say you have an income of $100. How much are the expenses? So let's take two cases. In case A, the expense in US have been taken as $80. Income is 100, expense is 80, so obviously Actually, the receipt is 100, the expense is 80, so the income is $20. The income is $20. Let's say the tax rate in US is 35%. So 35% of 20 gives you $7. So in US, the total tax which is payable is $7. But against this, there is already a withholding tax of $10 in India. Assuming the foreign tax credit is available, there will be no further tax which has to be paid in US. On the contrary, there is an excess withholding tax of $3 which has been levied by India. Right? Let's take another example. The income remains at $100. Case B, the expenses are $60. Now if you see the income is how much? It's $40. If you apply the tax rate of 35%, the tax which is payable in US is 35% of 40 or $14. Right? Out of this, if suppose the credit is available for $10, $4 needs to be paid by this company to the US government. Right? This is how basically the taxation for royalty and FTS and the right between the two countries work. Like I said, the set-off of losses, the carry forward of foreign tax credit. So in this case, what happened is you had an excess payment of taxes in India. Right? If you remember, in case, for an Indian business, there's a business loss, it is allowed to be carried forward to future years and set off. Similarly, many countries have rules whereby the foreign tax credit which cannot be utilized against the taxes payable in a particular year are allowed to be carried forward. So the set-off of losses, the carry forward of foreign tax credit shall be as per the local laws of US and other treaty provisions.